tightening the screws on lending standards. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. Today we look at Westpac's announcement that they are tightening their expense analysis for mortgages. I think you can probably hear the sound of doors firmly shutting after the horse has bolted. And I wonder if this might impact the current asset case on mortgage underwriting against Westpac. But that said, the bank will still apply either the higher of the customer declared expenses or the household expenditure measure HEM for serviceability purposes. So HEM will still be used, warts and all. The bank has updated its credit policies, so borrowers' expenses will need to be captured at an itemised and granular level across 13 different categories and must now include expenses that will continue after settlement as well as debts with other institutions. We have to wonder why this was not done before. These changes will apply to all loans submitted to any bank within the Westpac Group from Tuesday the 17th of April. The stated aim is to provide a more accurate view of borrower expenses so that the bank can better determine their financial situation and repayment ability. So now, brokers are being told that they can no longer bundle living expenses. Instead, for all loans submitted from Tuesday the 17th of April, brokers will need to capture all applicable expenses over 13 categories during the needs assessment conversation. The absolute basic expenses will be replaced with 7 mandatory expense types. These are clothing and personal care, groceries, medical and health, transport, insurance, telephone, internet, pay TV and media streaming subscriptions, recreation and entertainment. There will also be an additional optional expense type 2. These are owner-occupied property utilities, rates and related costs, childcare, education, investment property utilities, rates and related costs. An additional category of rented property utilities and related costs will be applied if the customer's post-settlement housing situation is either rent, board, or living with parents. Where an applicant has this type of post-settlement housing situation, if the monthly rental amount is stated to be less than $650 per month, a notional rent of $650 per month will be applied automatically to each applicant on the loan, regardless of marital status. For other categories, the Westpac Group has outlined that a broker will still be able to enter $0 for an expense type. But for certain mandatory expenses, when 0 is entered into an expense type, the broker will need to select a reason to explain why that expense does not apply to the applicant. It will also be mandatory for the customers to provide evidence of other financial liabilities, including ongoing rent, board, child support, and any secured or unsecured debts held with other financial institutions. These can include documents such as bank statements, signed and dated rental agreements, letters from property managers, and transaction listings, or even a court order or child agency support letters. For debts with other financial institutions, the documents cannot be more than 6 weeks apart from the allocation date. This documentation must be included in the loan application submission. Assessors will then verify the documents submitted. The existing requirements for HELP, HEX and TSL debt will still apply. Finally, the customer must also sign a financial acknowledgement as part of the loan offer documents, indicating that all details relating to expenses and debts are true. The bank said, Westpac is committed to responsible lending and ensuring that we have a clear understanding of our customers' financial situation. We are proud to work closely with our broker partners to continue to meet our responsible lending obligations and do the right thing by our customers. That's why we are updating the Westpac credit policies to enhance the way we capture living expenses commitments and to verify documentation. It added, it's all about looking after the customer by fully capturing their financial commitments to ensure that they can adequately manage the mortgage liability they are potentially signing up for. Of course, This move comes just weeks after the Royal Commission into Misconduct into the banking, superannuation and financial services industry questioned whether credit providers have adequate policies in place to ensure that they comply with their obligations under the National Credit Act when offering broker-originated home loans to customers, insofar as those policies require them to make reasonable inquiries about the consumer's requirements and objectives in relation to credit contracts, to make responsible inquiries about the consumer's financial situation, and to take reasonable steps to verify the consumer's financial situation. Despite the Commission raising questions over whether the use of benchmarks is appropriate when assessing the suitability of a loan for a customer, the Westpac Group changes will still apply either the higher of the customer declared expenses or the household expenditure measure, HEM, for serviceability purposes. The Commission was damning in its critique of the lending policies when it came to ensuring that customers can afford their home loans, with ANZ being called out for their lack of processes in relation to the verification of a customer's expenses, and both Westpac and NAB revealing that there had been instances of their staff accepting falsified documentation for loans. During the hearing, we also heard that there had been at least 55 instances of Westpac staff either falsifying or accepting falsified supporting documentation in connection with home and personal loan applications, and a number of instances of Westpac staff receiving payments from referrers for the referral of customers to Westpac for loans, while some NAB staff members were allegedly charging NAB customers a fee for personal loans made as cash payments under the table. So the move by Westpac marks the first wholesale change made by the major banks to tighten up their expenses collection processes following the Royal Commission. And I expect other banks will follow in the footsteps of Westpac and make similar changes to their expense verification processes in the coming weeks. And remember that so far, mortgage borrowing power has on average already dropped by 20% compared with last year. So this tightening of lending standards will put more brakes on credit growth and probably put it into reverse. If you liked what you saw here today, please do like the post and leave a comment. And if you've already subscribed, thanks, I appreciate your support. If you have not yet done so, please do subscribe to get alerts to new posts. I'm Martin North, the Principal of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.